Just a short while back, you'd have seen blaring headlines. Retail inflation at record lows. That was a reading for the month of October. And you can imagine people shaking their heads thinking, that doesn't mean anything. My bills keep going up. What does inflation at 0.25% mean? And you can't see the effect. Does low inflation have a bearing on growth going forward? Is it a reflection of subdued demand? What does that mean for your investment portfolio? And how should you account for inflation when you're planning for your long-term goals like retirement? This is Moneywise on NDTV Profit, and we're getting answers to all of those questions. Joining me on this episode is Madhavi Arora, who is lead economist, Emkay Global Financial Services, and Nisreen Mamaji, CFP and founder of MoneyWorks. Thank you so much to the both of you for taking the time. Let's first start with, and this is kind of like economics for dummies. Madhavi, for those of us that don't understand, why is inflation at 0.25% right now?
So I think, it's a blend of 2 or 3 factors. As you rightly said, it doesn't feel like we're in a near 0% inflation, right? It's an emerging economy. It has enough bottlenecks to have a high inflationary scenario. And in the urban sector, we do, sense a much higher personal care inflation, housing inflation, and other factors. But again, this is the statistical number, right? So it also has statistical anomalies. Things like base effect, which basically means last year, same period, inflation was very high. So on a year-on-year basis, it is much lower. Secondly, you also had, if you recall, we had the GST cuts in September near end of September, which is also disinflationary in nature because it was impacting a lot of personal care goods, healthcare, auto sector again, a big beneficiary of, lower GST taxes. So when the tax incidence came down, that also had a momentum price effect, in the economy, which was also felt in the month of October. And more importantly, the food prices, especially the perishable goods, they tend to get into the disinflationary zone during winter period, right? I mean, you know that vegetable prices tend to become much cheaper on a month-on-month basis, which also was felt. And, to be very fair, over the last few years, policymakers also have made an effort to ensure that price volatility is only very short-term and doesn't really percolate down into the long-term inflation. So all of that combined has given you a very beautiful number, which is 0.25%. We are not a 0% or 0.25% economy. I think you need to just remove the noise from the numbers. And if you look at a more structural basis, we are definitely much low-inflation, in a much low-inflation zone compared to what we were, say, 2 years ago. And probably this year, average inflation this year is going to be close to 2%, owing to various factors, one of those being, of course, GST as well. Even in removing the GST effect, a partial benefit of that, which the consumers are enjoying, inflation would have not necessarily crossed more than 2.5–2.6% this year. Including GST, it's probably going to be much lower than 2%. So you are staring at a close to 1.9% kind of an inflation in FY26, fiscal year 26. Next year is going to be worse because the base effect, as I talked about, will be
so it's
worsening.
going to be higher.
Yeah, it'll probably touch a 4%. So ideally speaking, you take an average of 2 years to get a sense of inflation, which is like a 3%, 3.5% inflation in India.
Yeah.
On a statistical basis, which is still a low number for an emerging market like India, which is used to seeing a 6% kind of inflation maybe 5 years ago.
Absolutely.
But we are in a low inflation zone compared to a decade or a 5 year.
A decade and a half back, you were talking about double-digit inflation, right?
Yes.
Which was a problem. We're no longer like that because the central bank also ensures that we're keeping inflation within a certain range. In case you didn't know, 4% plus or minus 2% is where the central bank, that is the Reserve Bank of India, keeps inflation. But the point is, Nisreen, on the ground, and you said it well, it's a statistic. It is affected by statistical anomalies.
Right.
When I go to the Bhaji Mandi or when I go and buy something, I'm not talking about inflation, right? I'm thinking about what the price is. And ultimately, my bills don't change.
Right.
We're talking about a deceleration in the rise in prices. Prices are still going up.
Still going up.
And so from the perspective of personal finance planning and planning my money, why is it important to look at inflation, as you point out, generally at 5 to 6%?
So typically, you look at an average, at least of the last 10 years, in order to calculate for future planning, because normally when you're getting into planning, you're planning for retirement, you're planning for a child's marriage, you're planning for a child's education. So you're looking at a 20 or 30 year, forward-looking kind of a scene. So when we do, for the purpose of calculation, 5 to 6% would be an average that we take for calculation purposes, because otherwise, if you are, too optimistic and you calculate, 2%, which is just the current figures right now, which may not last. So, you can't be, for calculation purposes, for forecasting purposes, for, looking at the future, if you look at a very low figure, it's possible that your entire calculation and planning goes for a toss. So to be very realistic, honestly, if you look at a 5 to 6% average of a decade, which has been historically, the Indian inflation rates going back, when you look back, the last 15 to 20 years, the inflation has been, say, 5 to 6%. And here, you're talking about, say, consumer price index, whereby in a particular month, we are seeing 0.25.
Yeah.
And as she rightly said, during the FY 25-26 is going to be, possibly higher. So
27 next
27
year.
the next year. So on an average, it's better to be realistic than, to be optimistic and consider lower rates of inflation. Because, say, for example, you're expecting your portfolio to give you a 10% return over the next decade. And your inflation is, as we calculate, at 5%. So your real return, Alex, is only 5%.
Yeah.
So that helps you.
Not even accounting for tax, yeah.
Not accounting for tax and expenses, So you have to take a very realistic view when you're doing your asset allocation.
Sure.
Otherwise, everybody would just take the risk-free return and be very happy with it. But they would not be able to beat inflation.
You make an interesting point. But since we have an economist in the room, I want to ask you about this, right? Because ultimately, we have seen this inflation targeting for the central bank for a little while now, and we've kind of gotten used to it, right? The average person will not be looking at it very closely, but they know about this now, and hopefully you can look at it, look this up. The question to you, Madhavi, is: do you anticipate that 5 to 6% for retail inflation? And we'll talk about what you feel in your own basket. Is that something that you anticipate for the long haul, or do you think that as we move into the higher realm of things, we're already one of the largest economies in the world, we're growing faster, but we'll reach scale at a certain point? Do you see that higher inflation staying the case, or do you think that we'll trend lower from here on out over the next decade and a half?
I think the next decade, it's a long-drawn period, because there'll be a lot of things that are going to be happening. It's not just India-centric. Say, for example, food inflation globally is going to be a problem. There are supply bottlenecks in the agriculture sector. You're also seeing more frequent droughts, or more frequent, agri shocks around the world, climatic changes. So all of that will imply that the agri-inflation will probably be the theme for the next decade. And, we're being very realistic about it. We all are aware of it. And India, at this point in time, is still a more food-oriented economy. As per our food basket, the CPI basket, food inflation has a highest weightage, almost 50%, which obviously is, last it was done was 2011-12. Clearly, the economy has evolved. The rural and semi-urban economies also have become much more urban-centric. So an urban economy has become much more urban than what it was a decade ago or 15 years ago, rather. So clearly, you are using the CPI weights, which were 15 years, ago were done in the survey. So I think next year we are going to be coming with the new CPI series, which will have a more realistic consumption patterns. And as I understand that, you will see the share of food going lower, just like any other emerging or developed economy. As economies develop, their share of non-food categories increase. Their disposable share obviously becomes more non-food centric than food centric, which will happen both in urban and rural economy in India. And segments like, say, housing, which is around 10% of India's CPI weight, will probably become a 15 or 18%. Because at least in the urban sector and urban economies are, again, housing is the biggest cost for most of us. As a part of our disposable consumption or disposable income in general. So I think if I look, say, more 5 to 7 years or a decade from now, as I said, one would be agri-inflation, which will be a problem globally in general. So we'll also bear a part of it, which means more volatility, if not, higher inflation per se, but more volatility in inflation, which is also not good when you're doing asset allocation in the more medium term. Second would be shift in the weights of our consumption patterns. which will be reflected in our index. And third, I think, will also be improvement in global productivity and domestic productivity. So as the productivity of labor and capital improves, the productivity of the economy improves, essentially inflation comes down, right? The cost of doing things reduce.
Right.
So I'm assuming that we will go up the productivity curve across factors of production in India, which, and around the world also, that may also happen. Technology will be a biggest lever in that. The overall cost of production in general will come down, and which will also imply that the retail cost, will also be much lesser. So technically speaking, next decade or so, a more improved efficiency in factors of production ideally should imply lower inflation. But again, the factors which are not in your hand is, the weather vagaries and all of that, which can keep it volatile.
Sure. So I do want to get into, before I talk about asset allocation and how you should plan for your long-term goals, the cost of low inflation and whether we're truly seeing low inflation. The reason I ask is to come to your original point, because food, you're actually seeing deflation in a lot of these pockets, right? And core inflation, which is non-food and non-fuel, is at 4.4%, right? So which indicates that outside of food, outside of fuel, which has been depressed relatively, you actually are still seeing prices go up. What does that mean for growth? Is it indicative of consumption at all? Will the Reserve Bank of India react to this in cut in December? And what are the broad implications for growth?
So the 4.4% you're talking about, to a large extent, it was impacted by the gold inflation. And again, gold is not in my hand, right? So gold, last 2 consecutive months have seen 13-14% month-on-month increase, September month and October month. Both of them were reflected in the CPI inflation as well, right? So you need to remove that noise, because that's not generally when you talk about core inflation, it is basically also a reflection of demand dynamics. The companies, when they are sort of charging me, they would have to understand what the demand dynamics are, whether they're able to pass on the higher cost to the consumer, or they have to bear losses in their books or reduce their margins. All of that also is impacted by the demand dynamics. So to be very fair, last 3-4 years, if you look at the core inflation, actually has been trending down on an average. Last 3-4 months has been very volatile because of gold. If I remove gold, your core inflation is actually running sub 3.5%.
Wow, okay.
Right? So you are in a low-inflation zone in India versus, the past trajectory of Indian inflation.
What is the cost of that, though?
See, low inflation is actually good for you purchasing power. My real purchasing power goes up, right? Whatever income I have, on paper, I'm paying much lesser in general. Again, I'm not going commodity-wise. I may be still paying much higher rentals. My rental inflation is every year at least 7-8%. CPI inflation just shows a 4-5%. That's not necessarily the case, because it's, again, different cities will have a different dynamic. But in general, low inflation is good for real purchasing power, because it improves my purchasing capacity with the same income that I'm having. So that obviously is actually a de facto consumption boost. And policymakers, that's why would like to have a moderate inflation in India in general. A very low inflation is not good for producers, because they have no margins to produce, right? I have to have an incentive to produce. If I'm not even getting 1% return on my goods, why the hell will I produce? So the balancing factor is somewhere 4%, 5% for developing economies like India. But at the same time, a low inflation also it sort of boosts real rates. So my real deposit rate goes up.
Yeah, it's a good point. Which brings me to the investment perspective, right? When you are advising people, particularly about, and I know that you have bucket strategies that you talk about, you have goal-based strategies that you talk about. If you're talking to somebody in their mid-30s with a child, you're talking about how do you account for inflation in education 15 years down the line or 10 years down the line? And that you're talking about double-digit inflation, right?
Absolutely.
So how do you account for inflation when you're mapping these things out? You talked about a blended rate or an overarching rate of 5 to 6%. But when you're talking about these individual goals and you're talking about your medical requirements when you're hitting retirement, ultimately you're talking about double-digit inflation.
Absolutely.
So how do you account for that?
So basically, when you're looking at education, it's we look at a calculation purposes 8 to 12%. Okay, now this is the reason being, your books are going up. the faculties, salaries are going up, your infrastructure costs are going up. So those are some of the reasons why it is, absolutely the statistics have proven that you're expecting at least an average 10% inflation rate for education. As far as the medical goes, it's nearly 14%, which is, the actual figures. And for calculation purposes also, if you consider 14 to 15%, it's really very high because of obviously in the infrastructure cost, the hospitals, the pharmacy bills, radiology. I mean, even if you just go for a normal doctor's visits today, between, 2 consecutive years, if you're going for an annual checkup, you will know that, these rates have gone up. So if you're forecasting for the longer period, this does become a challenge. So, the blended rate that we normally would consider would be, you're trying to achieve at least a 15% growth rate because if your inflation is, your blended inflation is 7 to 8%, your real return has to be at least 5%.
Sure. So the outcome in this case is you're saving for education separately, but assume that you're early on, you're 30 to 40 or 30 to 45 even. At that moment, you can cover your health costs with insurance, right? Which is great.
Right.
So you don't have to essentially spend out of pocket when you have, or if you have a reason to.
Yes.
But you can't do that when you're 60. So you're saving now for those medical requirements when you're 60 plus, because you won't get a health insurance policy that you can afford at that point. Is that the right interpretation?
That's absolutely correct. But, at least if you're living in urban India, so even today, you should take a cover with a floater which is higher than what you need.
Sure.
So that when you reach, that position at age 60, you will still have a realistic cover.
When you but just to drive home the point, you're saying that if you don't claim this, it'll keep rising because you have your no claim bonus, right?
Right. But that's up to a limit,
Up
so
to
the
a limit.
no claim bonus is not infinite.
And you revisit this every year, right? And your premium every couple of years or every 3 years will
every
go
4
up.
years or every 5 years,
Right.
would
So,
increase.
so you don't have the option to buy a new policy when you're 60 plus.
If you are, if you have already been diagnosed with any illnesses, yes,
Sure.
you may not have the option to buy. So that is why when you start the policy itself, you should be taking a policy which is at least 5 to 10 times more than what you need for today's rates.
Right.
So today if you need say a 5 to 10 lakh cover, opt for a 50 lakh cover, maybe with the top up, So there is an option of taking a top up policy also.
Sure.
So your base cover can be say about 10 to 15 lakhs and your top up can be another 15 to 20, at least 40 to 50 lakhs. So you have to think, what is going to cost you when you're age 60 at that purchasing power parity, for you to maintain that in health.
Is it
reasons.
because it makes it easier for you to get a policy when you already have a policy? Is that what you're saying?
No. If you don't have any illness, it's obviously easier.
Sure. Okay.
So if you're not diagnosed at age 30, you're expecting to be fit and fine.
Yeah.
So take the policy then, take a very good top up as well, so that same, then the insurer cannot reject you if you continue paying the premiums.
Okay. But
so
do you also save for medical purposes when you're 65
So,
plus?
another option to do it is besides going in for your insurance cover, because a lot of people also just, rely on the company policies. And they are resisting to take, their personal policies. And sometimes if there is a job loss, then you're kind of stuck.
Sure.
So for such a person or even otherwise, you can have a separate investment tool for medical emergencies, So when you're doing your asset allocation for various goals, medical can be one of them.
Okay.
So you do emergency planning, you plan for your children, you plan for your retirement, you also plan for a medical issue so that, you can self-fund if something goes critically wrong.
Important.
And you don't have a critical illness policy or you're running short. That could very well be the case because sometimes you go to a hospital which is beyond your limits because a certain doctor, certain treatment is available there.
Yeah.
So for that kind of planning, it's also good to have a separate investment vehicle for that particular emergency, which is very likely
Absolutely.
to
Also
occur.
add holidays in that. You should have
Holidays, 100%. Everybody has
We're getting
holidays.
too much
That
into
is-
medical
that is-
aspect of it. Let's be a little happy.
Yeah, absolutely.
It should be a holiday fund.
Holiday fund.
Always.
Always.
Nowadays, if you talk to a 30 or 40-year-old,
Yeah, I have a
holidays
holiday
is the
fund.
first
You have a
one.
holiday fund. How do you account for it?
Absolutely.
So 30
So my manager takes care of it. I'm going to connect with her later after the show.
Definitely.
That's a good idea. So holiday fund as well. So
Yes.
what you're essentially saying is everything you save for, you account for inflation.
account for inflation.
Now, you mentioned asset allocation, right? And at the cost of bringing this back to a slightly boring conversation, but important nonetheless, right? How much of a bearing do you think that a low inflation will have on your return expectations? And just from a broad standpoint, you would generally benchmark your expectations of returns on nominal GDP, right?
Correct.
Because your earnings of companies that you invest in are tied to that. If inflation is low, your rates go lower, the yield that you get from your instruments that you invest in debt goes lower.
Correct.
All of that is tied, isn't it?
Correct. I agree with you. So asset allocation becomes very tricky. In equities market, everything is, hinged to nominal GDP. And if you're looking at an inflation which is less than 1%, which basically implies that the nominal GDP growth is probably going to be even sub 7.5–8% this year. So that will, have a bearing on earnings. And if you're not even expecting earnings growth to be in, high double digits, then you're basically looking at a much more muted, returns also in the equity market. So I think to that extent, one has to keep in mind that low inflation also comes with a cost for the companies, especially in terms of profitability and stuff like that, and eventually will have bearing on equity market. And as you rightly said, a low inflation also tends to lead to, on a fixed income perspective, a much lower yield on, on your bond products. So clearly, a low inflation basically will be, will be basically implying that the yields will be much lower, and thus all of your fixed income products obviously will not be very lucrative. So that becomes a little trickier period. But again, as I said, it's just a very short-term period. As we were discussing, inflation, at least urban inflation, isn't like a sub 1%,
Sure.
And whatever said and done, at least in the fixed income side, people actually have had MTM losses because bond yields have not come off.
Yes,
in
exactly.
line with the kind of cuts and the liquidity that one expected to have delivered. So,
but if you're tracking the bond market, is also because of foreign institutional selling and all of that, right?
A lot of other factors. Domestic guys also, there's a demand drought and all of that.
But on the point of yields and on the point of policy, right, reaction, do you anticipate that the Reserve Bank of India will cut in December, and how much do you expect them to cut in this cycle?
So they've already delivered almost 100 bips plus, right?
Yes.
And I'm saying 100 bips plus because they've also given liquidity in the market and have also eased regulatory norms, for the banking sector.
Sure.
Which also de facto is easing, right? If you're making financial conditions easy by easing the lending conditions to, risky profiles, somewhere you're also, leading to a much easier monetary conditions in India. So it's actually more than 100 bips that RBI actually has delivered, plus the liquidity that they have taken care of, which is currently sort of very sideways. But I think they're still behind the curve. We've been arguing as a house that RBI should be cutting rate. They're behind the curve because they have been basically focusing a lot on what will happen a year from now on inflation.
So how much is still left?
I think probably 25 bips at least is sort of what we are pricing in, and we're not necessarily ruling out another rate cut after that. So maybe a maximum 50 bips.
Okay.
Yeah, of which the one which will actually fell to you would be for 50% of that, to be very honest, in the next 6-9 months.
Because of transmission, right?
Yes.
So therefore, assuming that you have your policy rate expected to fall between 25 and 50 basis points more, there are a couple of things that you need to bear in mind in terms of your planning for the next year, right? How do you account for where interest rates are and the cost aspect, the cost and the tax aspect, when you need to achieve that real rate? Right now, it's easier to achieve, but down the line, it could well be harder.
So, when you make a strategy, Alex, you're planning for the next, say, 10 to 15 to 20 years. So, you can't change that midway. Depending on geopolitical issues, depending on, tariffs, depending on the GST cuts, depending on the interest rate changes. So you take into account that maybe you are expecting, say, 10 to 12%, because if you're looking at, say, 7.5% is your GDP, or inflation, say, 4-5%. So 12% is a realistic, view. Return expectation for a blended portfolio. And the portfolio could be aligned, like if you're, starting, if you're 30-35, you can be 60 to 70%, say, in equities. You can be 30% in debt and fixed income, and say maybe 10% in gold. So if this is the way that you plan the portfolio, you can't keep on making tactical changes depending on, how the interest rates are changing. But you could definitely look and review every 3 years or every year also as to how the entire portfolio is, being the blended portfolio, along with, the various rates that you have calculated, whether you are on track for that particular moment in time, So that's how you can keep on reviewing and managing to be on track, because if you're looking at 15-20 years, you can't keep on rebalancing on an annual basis, because there's a cost attached to that. There are expenses and there are taxes also. So if you're looking at say 10-12%, your expenses about 2-3%, maybe less, say 2-2.5%. You know, taxes say for an equity portfolio 12.5%, debt portfolio will be your slab rate. So then your real return is going to be very much, you know, compromised by that. So when you're, for the purpose of calculation, it's always better to take a post-tax and a post-expense return, and then you do your math.
What is the one trick that you would say to beat inflation on a consistent basis? Is it incrementally increasing your savings over the years?
Definitely. So it's, you know, a step-up SIP is actually a very golden tool in your hands, because that extra incremental income that you have every year, you know, salary increase, bonus, etc. So you have to be very disciplined, and that anything extra that you have in your hands, you know, don't start consuming to a large extent, because your lifestyle need not go up, you know, to a large extent. A marginal increase in lifestyle obviously is expected, and we are all aspirational. And, you know, when you have the little extra money.
And you need those holidays.
And you need those holidays, absolutely.
Yeah.
And when you have the little extra in your hands, you know, you're supposed to enjoy it. Otherwise, there's no motivation for you to, you know, carry on doing what you are doing. So, of course, as human beings, we all want to do that. But the discipline has to be there from you. That anything extra, like even if it's, you know, children get sometimes covers on their birthdays and they don't need multiple toys. So you give them one big toy, and the rest of all that, just keep on investing on the child's name. I think these very, very small and simple things.
It sounds great.
If, you know, the parents can do and we can all sort of advise, it would be really nice. And that's how the portfolio increases. So it's a very simple tricks, as you said, but very simple thinking. And step-up SIP is actually a fantastic and golden tool.
On that note, ladies, thanks so much for taking the time. Pleasure having you. You know, I must confess that this is a more technical conversation than I've had in the recent past about inflation and why it is where it is. It is unlikely to be here for very long. And hopefully, we've helped you in your long-term planning. Let us know what you think, and do stay tuned. Lots more coming up on NDTV Profit.